Let's kick off this week with the most trending and controversial and honestly, the most crazy, insane news in the business world, Gamestop. Because who buys physical video games anymore? In the middle of a pandemic? Nobody. So the retailer announced it was going to close some 450 stores this year. The company went public in 2002, and since then, its stock has traded in the New York Stock Exchange without any fuzz. And GameStop stocks traded at $4 in the first half of 2020. By October, that had tripled to $12. And as of shooting this video, Thursday, it's valued at over $300. That's 100 times more than 12 months ago. And what is this insanity on a company apparently about to go bust? It's a group of degenerates called wallstreetbets, a subreddit that became popular with investors YOLOing their money on Robinhood. wallstreetbets has grown quite crazy as well. It's doubled its subscriber base every year since 2017, is now at 5 million degenerates, as they actually call themselves. And the reason for this insane spike in stock price is a literal battle between these retail investors and big money investors in Wall Street. Let me explain. As GameStop's downfall was announced, Wall Street hedge funds decided reasonably to begin shorting GME stock. And if you don't know what short selling is, a Wall Street Bets degenerate would tell you to go watch The Big Short. The Big Short would have Margot Robbie explaining that to you, but all you have today is me. Normally, when you believe a company is about to grow, you buy its stock and the stock price goes up. You make money. Simple. But Wall Street, in its infinite greed, came up with a way to make money if you think the stock price is going down, and that's called shorting. Imagine a Wall Street investor who believes GameStop stock, which was at $35 per stock at the beginning of this week, was overvalued. What they would do to make money from that is borrowing shares and selling them to someone else. Let's say that they borrow 100 shares and they sell them to another investor who believes the stock will continue to grow. That investor is now short 100 shares. They own 100 shares. The loan they got is not for the worth, for the price of the shares, it's for the shares themselves. So let's say that the next day the stock falls to $10, as it should have. Honestly, because GameStop is dying, it's a dying company. So the investor closes this trade. He buys the 100 shares that he owes from the market at the current market price of $10 each. So he paid $1,000 to pay back his 100 share loan, but he had sold those shares the day before for $3,500. He just made the difference, $2,500, by betting against GameStop. Now, very important, the short sale is possible by borrowing the shares, which may not always be available if the stock is already heavily shorted by other traders. And that was the key to this thing. So when GameStop stock price was pushed up by the Wall Street Bets crowd, large hedge funds started heavily betting against it, shorting, borrowing shares, and they would have made tons of money, but Reddit was bigger. You can call them autists, again, that's how they call themselves. You can call them trolls, but they didn't sell. They kept buying GameStop stock. While the hedge funds waited for the stock price to drop, Reddit decided to hold and to buy more. Add to that the insane leverage that Robinhood can give them, the stock price just kept going up. That's known as squeezing a short position. This may be known as one of the most iconic short squeezes of modern times. Since shorting requires borrowing stock, scarcity is created. Somebody needs to buy the stock to lend it. So supply and demand, price goes up, insane, exponential, to the moon. According to Business Insider, as of Wednesday, losses for the short sellers piled up to around $5 billion. Wall Street investors are calling this market manipulation, which is just being a hypocrite.
The reason the market is doing what it's doing is people are sitting at home getting the checks from the government, okay? And this fair share is a bullshit concept. It's just a way of attacking wealthy people. And, I think it's inappropriate. We all got to work together and pull together.
They're the ones usually controlling or winning these gambles. And when it's them winning, it's just the way the market works. Adding fuel to the fire, Robinhood halted trading for GameStop and other stocks being rallied by Reddit as of Thursday afternoon. This was met with outcry from the Wall Street Bets community and threats of a class action lawsuit against Robinhood for market manipulation, because it is. If you can't trade the stock, it is, I guess, market manipulation. Degenerates on Reddit also saw support from their brothers abroad who vowed to continue rallying the stock. This is a fun and inspiring story for this 2021. Also, prove that we are in a clear stock market bubble that will probably blow up this year. But in the meantime, let's just ride the train, I suppose. And honestly, I loved reading this story this week. I loved it because I've been lurking Wall Street Bets for years. I've been watching their silly memes. I've been experiencing FOMO myself on the stuff that I didn't buy. I've been laughing at them drinking their own urine on the bets that they make. And so I didn't have to do any research to write this piece. It's like that pop culture reference Tarantino makes in the movie, and you celebrate because you got it. This was fun. Whew. Okay, so that's way past the 5-minute mark for the news, but let's keep going with some other stuff. Tesla. On January 22nd, the company filed yet another federal lawsuit against the former engineer who allegedly moved sensitive information to his personal Dropbox account. The data transfer included some 26,000 highly sensitive files that would inform competitors of which systems Tesla believes are important and valuable to automate and how to automate them, providing a roadmap to copy Tesla's innovation. That's what the lawsuit said. For some reference, only 40 employees in the whole company out of the roughly 50,000 had access to this information, and this guy was one of them. Reportedly, only 3 days after joining the company as a senior software engineer, they detected the irregular movement of files and confronted him over a video call, of course. To his defense, the engineer has said that it was a misunderstanding and that the files were moved by mistake. Interviewed by the New York Post, the guy working from home argued that he unintentionally moved the folder into his Dropbox while trying to make a backup. He said that he wasn't aware of the number of files contained in the folders. However, Tesla says that the scripts he downloaded had nothing to do with his company responsibilities. They also say he tried to remove traces and deleted the files, but he says he was instructed to do so. And this is not the first time that Tesla has had to go after their own employees. In 2019, the self-driving tech startup Zoox agreed to pay an undisclosed amount of money after admitting that some employees had unlawfully extracted and misused sensitive data from the company. Another former Tesla worker and whistleblower recently agreed to pay $400,000 to settle a similar accusation. So things may not be looking too bright for this guy. So what do you say? Was that an honest mistake, or was he stealing some code from Tesla? Let's move to some actual startups now. Blackcard, that's a Canadian-based startup working on one of the main challenges of the online shopping experience, the inability to try on or test out some products before buying them. The company recently closed an $8.8 million Series A after having received around $2 million of seed funding just last year. With this money, they hope to grow fast and integrate with more businesses as they capitalize on the e-commerce boost driven by the pandemic. Their solution is simple. With Blackcard, you can order an item to be delivered to your home and only pay for it after a period of time that the vendor gives you to try out. The CEO, Donnie Ouyang, says that the platform is ideal for try before you buy. Anything that's moderate to high price points, lower frequency of purchase, where the customer is making a considered purchase decision. That's the stuff that performs really well. They have expanded their offer to electronics, jewelry, home goods, and more. The platform has been adopted by more than 50 medium to large retailers, as well as e-commerce startups like luxury sneaker brand Koyo, clothing startup Dia & Co, and more. Business names like Shopify and WordPress are also getting into it. Blackcard claims that its merchants typically see conversion rate increases of 24%. Average order values climb by 51%, and bottom line sales grow by 27% after integrating their solution. They make money by charging merchants a percentage of the sale once the customer keeps the item. And the company aims to close around $250 million in transactions through the platform by the end of 2021. And I honestly can't wait to try it out. 2020 was the year that finally converted me to exclusively online shopping for clothes. I found brands that I know fit me well, and I just order online. I don't see myself walking into a store anytime soon, to be honest. Anyway, last but not least, let's talk about menopause. According to a Crunchbase news post, with data from the Female Founders Fund, over 1 billion women can be postmenopausal by 2025. And that alone can represent more than $600 billion in spending opportunities tailored to women in this stage of their lives. The report claims that most of the medical advances in women health tech have been focused on birth control and fertility treatments. Investors from this female fund believe the opportunity for a menopause market is huge and remains mostly untapped. Crunchbase states that more than $1 billion were invested in US women's health technology startups in 2020. That's considerably more than the $625 million in 2019, and it's a steady rise of investment in this space since 2017. However, startups focused on menopause have only raised around $250 million since 2009, according to investor Adriana Samaniego. So initiatives are more specialized every time, and most importantly, more feminine. Companies like Joylux and Genève, just to mention a couple, each have raised several $million in recent years, offering health solutions for the wide variety of menopausal symptoms that women can experience. The CEO of Genève has said, "We see menopause as the kickoff to the second half of life. How we manage menopause in our 40s and 50s will determine our long-term health." So it seems like a win-win. Women may be getting more quality of life, and investors and entrepreneurs will be getting more millions. That's just how the game works. Before you go, I want to do a massive shout out to you, community, and to angel investor Lenny Rakitsky. He posted a random Twitter survey the other day asking about companies doing good content marketing. And lo and behold, we were the most mentioned startup. Above Intercom, above Stripe, above Ahrefs, who sponsor our content sometimes, by the way, and above HubSpot of all companies. So thanks, community, for being so verbal about your support. We're glad our content was useful. Thanks a lot for watching. Lenny, thanks for getting us in front of so many new people. We'll see you all next week.